Hello, everyone. Logan Hertz here with Hazeltine LLC. I thought it was time we go through disability income insurance in a bit more detail. This is something that is oftentimes overlooked in people's personal financial strategy. This fits into the protection component of your financial picture, and it is protecting your ability to earn income. Offense wins games, defense wins championships. We need to set up the foundation of your financial plan first with protection, which means, as an example, good insurance policies. And then we move into savings, ideally in a whole life insurance policy or some safe vehicle. Then we can move into investing and speculating. But more people fail in their financial plans because they didn't have their defense set up appropriately than people who didn't play offense appropriately. What is your most valuable asset? If you ask this question, most people will think of maybe their house, maybe some stocks that they have. They'll think of what is the asset I have today that if I sold it would give me the largest amount of money. So for many people, that's their house. Maybe you sell your house and you get $500,000, but that's just a one time payout. If you think about it, your most valuable asset is the ability to generate income, the ability to generate income. And most people are collecting income through active income, meaning their job or their business. And a life insurance policy protects that income. So, God forbid you die, the death benefit pays out and replaces the income you would have earned over your working years and gives it to your family. A disability policy does the same thing, except it answers the question, what happens if you're disabled and unable to work? Well, a disability policy will pay your income for you. And this is a sample disability policy. This is with the standard, but there are other insurance carriers that are good that have disability policies. And I thought we'd go through this in detail because I think the details are important. But again, the general idea is this is protecting you in the event that you become disabled and unable to work. We'll get into a lot of details of how that might happen, why this sort of protection is important. But I'm going to go through this at an excruciating level of detail. Let me know if is this boring or is this actually helpful? I think this is probably helpful for some people. For some of you, your eyes just might glaze over and say this is way too much detail, but let me know. Pop a comment in or contact me directly and let me know if this is helpful or if this is just annoying and too detailed. So, this is a disability policy. This is prepared for John Smith in the state of Georgia. He is a male. Typically, with disability, there's really only two classes, smoker or non smoker. It isn't necessarily as nuanced as life insurance, where you might have multiple different classes that you get put into, preferred or standard or what have you. But more important than this health rating is the occupation class. And this right away is one area where a good insurance agent can help you. This makes a big difference. So if you are working at a desk job that's very low stress and doesn't require any manual labor, obviously it's less likely you're going to be disabled than the guy who, let's say, is walking on the power lines or doing some job that requires more exposure to the elements, more physical labor, and things like that. And so it's much easier to imagine a scenario where he gets disabled and unable to work. Because if you're working a desk job, you could have some physical disability, but that wouldn't interfere with your ability to generate income. You could still keep doing it as long as you can use a laptop. And in many cases, if you're working remotely, you wouldn't even have to have the ability to go into an office. So those sorts of occupation classes obviously get more favorable rates. And a good insurance agent will find you the best insurance carrier who's going to give you the best occupation class. That's important. And they will understand your duties and try and get you the best possible occupation class. That's really important. There are discounts for what they call preferred occupations, all kinds of programs that a good insurance agent is going to know about. I do not consider myself an expert in disability income insurance. I know enough to be dangerous, but I partner with other people who are experts. As an example, Ben Feigenbaum is one of my partners. He's been doing only disability insurance for 40 years, so he knows quite a lot about it. One of the services that we do offer is if you have insurance policies, really, if you have any financial information, send it to me. We'll review it and give you our thoughts on it. And in a lot of cases, we can help people to better understand what they have because many people who have disability policies, whether it's through an employer or individually purchased, don't really understand what they have. So we'll help you understand all the details of your coverage, what the limitations are, et cetera. We can even maybe help you file a claim if, God forbid, you have to file a claim, even if it's not a policy that I wrote. So if you have life insurance policies, if you have disability insurance policies, health insurance policies, any of your financial statements, whether it be bank accounts, mortgage, HELOC, retirement accounts, brokerage accounts. I'm not securities licensed, but I have partners who are, and we're happy to take a look at your overall financial situation and see how we can help optimize it. So send me your disability policy, especially if it's one through your employer. Most people who have employer provided disability policies have never really taken the time to understand what they have. They just signed up, which is good. I'm glad you have that policy. The most important thing, in my opinion, in a disability policy is this basic monthly benefit, the monthly benefit amount. In this case, it's $11,680 a month. The insurance carrier will cover up to 60% of your gross annual income, no more than that. So if they're covering 60% of your gross annual income, you are considered fully insured. If you make $100,000 a year, they'll only pay $60,000 a year to you if you are disabled. Why is that? Why will they not cover 100% of your income? For two reasons. Number one, no insurance carrier and no insurance policy ever promises to make you fully whole. That's not what they do. If they did that, they would have a serious problem because a lot of people would be fraudulently filing claims so they can collect income without working. And there's already some of that. The insurance carrier has to deal with that. And so they do not want you to be incentivized to file a claim. They want you to be incentivized to keep working and not file a claim. What they do is they turn an unmanageable loss into a manageable loss. That's why most insurance policies will have deductibles. So you still pay something out of pocket, but they cover the lion's share. The other reason is that when you receive this income, it's tax free. So your earned income is taxable, but the benefits you receive from an insurance policy are not taxable. You're being compensated for a loss. So 60% of tax-free income might equate to $60,000 of tax-free income might equate to, I don't know, $75,000, $80,000 of income if it were actually taxed. That's the second reason they don't cover all of it. Now they will cover all of it in some cases that we'll get to in a minute. This particular person, John Smith, we are assuming he makes $250,000 a year. That's his gross annual income. So if we multiply that by 60%, that's $150,000 a year. Divide $150,000 by 12, and you get to $12,500. This basic monthly benefit is a little bit less just because of some of the limitations around the insurance carrier. Won't get into that, but roughly 60% of his gross annual income is covered. His $250,000 of gross annual income is covered through this policy. The annual premium for that basic policy is $3,000 a year. So this brings out what I like to call the 1% rule, which is, I think, original to me, but it's a very, very rough rule of thumb, which is that if you have an asset, you should be willing to pay roughly 1% of the value of that asset in order to insure it. Your gross annual income is $250,000. 1% of $250,000 is $2,500. This is more because the coverage here is more robust. If you want really robust coverage, you might go up to 2%. $3,000 annual premium. The benefit waiting period is 90 days. This is long-term disability, not short-term disability. This is not intended to cover if you lose your income for a month. This is intended to cover if you lose your income for 6 months, a year, 2 years, while you're getting cancer treatment. So you would have to go the first 90 days with no income, and then your benefits would kick in day 91. So you'd use your emergency savings to bridge that 90-day gap. The benefits are payable to age 67, so roughly the span of your working life. We'll get to this later. You can actually keep this policy in force all the way to age 75 with some caveats, which I think is important because a lot of people are working into their 70s. But this will cover you to age 67. So if you were to be disabled in the worst case and you just unable to work, period, ever, then this would cover you all the way to age 67. These are some of the features that are included: presumptive disability benefit, family care benefit, rehabilitation benefit, survivor benefit. What do each of those mean? We'll get to that in a second. Let's get through these riders. All these riders are optional, but I want you to understand them because each of them can be important. Own occupation rider. What does this mean? This means if you're unable to perform the activities of your current occupation, but you are able to work in a different occupation, you can still collect benefits. This is really important. Disability policies who don't have an own occupation rider, you have to be disabled and unable to work in any line of work. But as soon as you go back to work and start earning income, you can no longer collect benefits. That's not the case with this policy. Let me give you a hypothetical example. Let's say you're a surgeon and you have this policy and you develop a tremor in your hands, which for most people is not a big deal. But for a surgeon, now you no longer have the dexterity in your hands. You're not able to perform surgery anymore. But you could go and teach at a medical school. So now you can collect the full disability benefit because you're not able to work as a surgeon, but you now are able to collect income working full time as a teacher. And now you collect both. The way that one of my partners explains this is this allows you to profit from a disability claim, which normally would not be allowed. So you might be actually making more income than before you were disabled because you're collecting your disability check and you're working full time in a different occupation. That's important. You can collect benefits not only if you're totally disabled and unable to work, but also if you're unable to work in your own profession, but you are still working in a different profession. Then there's the residual disability rider. This covers you if you have a partial loss of income. And I believe most claims are indeed residual. So maybe you're making $250,000. Now you have some restrictions about where you're able to go and what you're able to do. And now maybe you're only making $150,000. This residual disability will pick up the difference. You can imagine this, especially if you're in some kind of a sales role where you can, in theory, do it remotely, but it's a lot more difficult if you're not able to get in person in front of clients. And so your commissions are going down. This residual disability rider would make up the difference. Non-cancelable. This is really important. It sounds boring, non-cancelable, but it's actually a really great rider. It doesn't mean just that the insurance company cannot cancel the policy. It means a lot more than that. So what does this mean? This means not only can the insurance carrier not cancel a policy no matter what happens to your health, they cannot raise the rate either. That annual premium, here you're 40 years old, that annual premium will stay the same all the way to age 67, no matter what happens to your health, no matter how many claims you've filed. This is really important. This policy will cover you for your entire working life, no matter what happens to your health, and your premiums never go up, which is incredible when you think about that. That gives you some really great protection. This non-cancelable policy rider, what this is doing is protecting your insurability. One of those things that's so important is protecting your insurability. If you're young enough and healthy enough to qualify for insurance, lock that privilege in today because you will not always be healthy enough to qualify for insurance. So lock it in while you can. Lock it in at your current age so that it never goes up. So this is protecting your insurability. If you have disability coverage through your work, that's good. The problem is that policy does not protect your insurability because that policy is owned by your employer. You're just renting it from your employer. Your employer is under no obligation to continue that coverage. They might stop it at any point. Or if you leave that employer and go to a different employer, what if something's happened to your health and now you cannot get disability coverage? Also, I think a lot of people have not dug into all the limitations on employer provided disability, which again, it is a good thing, but you're typically not going to see disability provided through an employer that's going to cover you to age 67. It might pay for 2 years, it might pay for 5 years if you're lucky. It's typically not going to cover 60% of your gross annual income. It might give you a $5,000 monthly benefit, but it's not going to cover all of it. It's not going to get you fully insured. And again, send us your policy. We'll review it and explain it to you, explain how it works. This non-cancelable policy rider is really important because it protects your insurability. And that, in conjunction with the benefit increase rider, is really powerful. I'm going to jump down here and explain how these two work together. The benefit increase rider means every 3 years, you can increase the benefits without underwriting. Let's say your income goes up to $350,000 3 years from now. You can then add more disability coverage even if you have a cancer diagnosis, even if something horrible has happened to your health, you can add more coverage without underwriting. You can do that once every 3 years. And you can even do it more frequently if you have more than a 30% increase in your income, as an example. Then you can get more benefits added. Not only does it protect your current income, your insurability with your current income, it protects your ability to get future increases, which is incredible. This is like a guaranteed future purchase option. In addition, we have this automatic increase benefit rider, which means for the first 6 years, your benefit amount will automatically go up 4% per year. These are amazing benefits, and these are included at no cost. The non cancelable policy rider, in conjunction with the benefit increase rider, protects your insurability and not only your current income, but all of your future income. So that's very powerful when you consider the sort of protection this gives you. Let's go back to the occupation class for a second. This policy is individually owned, which means it goes with you, unlike your employer policy, which does not go with you when you leave or change occupations. The same thing is true of your occupation class. So if you get what in this case is the best occupation class, class 5A, that class stays with you too. So let's imagine I have a scenario like this: a man who was a physician and then he moved into hospital administration. If you're in hospital administration, that is a higher occupation class because you're no longer working as a physician. You're not doing as much physical stuff. You're at a desk job. That man gets the policy today. He gets the best class. He gets preferred occupation discount. Then let's imagine 2 or 3 years later, he goes back to working as a physician and he gets disabled. He's still covered by this policy and he still has that original occupation class. So that's really important and really powerful. Also, one of the things I can potentially help you with is if I look at your current policy, you may be eligible to get a better class. You might be eligible to get your class improved if you are working and you got a 4A or a 4P class for whatever reason, and now you've moved into a profession that's lower risk for disability, then we can get the rating improved on your current policy. I've also helped people with guaranteed purchase options. Some policies come with guaranteed future purchase options. And if I review your policy and I see that on there, you can now take advantage of that. It can help you add that. Index cost of living rider. What this means is if you go on claim, the benefits will be indexed to inflation up to a 6% maximum increase every year. This rider only goes into effect when you are on claim. It's not that your benefits go up automatically. That happens through the automatic increase benefit rider. This is if you go on claim. So if you go on claim, your benefit amount is indexed to inflation up to a 6% maximum annual increase. That can obviously be very powerful, very helpful, especially if you end up being on claim for a long time. Catastrophic disability benefit rider. This would allow you to cover your full gross annual income if you become catastrophically disabled. 60% of your gross annual income in most cases, but if you are catastrophically disabled, it'll pay 100% of your gross annual income. And the definition of catastrophic disability is the same as the definition of needing long term care, meaning unable to perform 2 out of the 6 activities of daily living or having a severe cognitive impairment like Alzheimer's or dementia. Another thing about working with a good agent who really has the experience and understands disability is we can help you file a claim. God forbid you have to file a claim. You're not calling a 1-800 number. We're helping you through that process and we are advocating for you, making sure you get that claim approved. Ben Feigenbaum, in over 40 years of doing this, and his father before him have never seen a claim denied by themselves because they're good agents. They know what they're doing. Just like I advocate for you when we are applying, trying to get you the best possible rating, the best possible benefits. Same thing if, God forbid, you have to file a claim. I'm making sure that claim gets approved. We can go through some of the more detailed definitions of these benefits. Family care benefit. This is, I believe, unique to the standard. Receive benefits when you are away from work and lose income in order to care for a family member with a serious health condition. This is really powerful because what this means is it covers not only if you get disabled, but if a family member gets disabled and the family members do not have to go through underwriting, only you do. This could help you if a family member is not healthy. There are limits. We'll get to that later. Obviously, the amount that you can receive is not unlimited, but that's a very nice benefit that I believe only the standard offers. And here you can see some of the more specific benefits, some of the fine print, which I'll go into in more detail. So this is just, again, some of the fine print on some of these riders. You can read, you can pause the video and read through that if you want. And then unfortunately it was cut off across 2 pages, but this is showing you the rest of it. So this is showing you the total benefit amount. It's a little under, but roughly 60% of your gross annual income. As you get higher on the income scale, these companies all have limits. We can still get you coverage, but we may have to get you a supplemental coverage. So if you're someone who is a high income earner and you want to be fully insured, what we'll do is we'll get you a policy through the standard or another carrier like that up to the limit of what they'll cover. And then we'll get a supplemental policy above and beyond that's underwritten by Lloyd's of London with a different carrier like Peterson, as an example, so that we can get you fully covered. In this example, we have a mental disorder and or substance abuse 24-month coverage limitation. This policy covers disability due to mental disorders or substance abuse. If you had some sort of mental disorder keeping you from working, depression, anxiety, whatever it might be, or a substance abuse problem that kept you from working, this policy would cover that. What we're doing is we're limiting those benefits to 24 months in order to get this discount. But you could have that unlimited coverage to 67 if you wanted. But by limiting those benefits in those cases to 24 months, we're getting a $638 discount. Preferred occupation discount. If you're working with a good agent, he'll know when you're eligible for this. We get a discount for e-applying rather than doing a paper application. Your total annual premium with all the riders we added was about $6,300. These discounts drop it to about $4,100. So less than 2% of your gross annual income. If you make $250,000, $5,000 would be 2% of your gross annual income. This is fairly robust coverage. So we can scale that up or down as you like. It's really up to you, the client, as to what kind of coverage you want. This grid here shows how we can vary the waiting period and the benefit period. We've chosen a 90-day waiting period. So you'd have to go 90 days without income before you could start receiving benefits. And benefits are payable, and this policy stays in force to age 67. You can see how if we made the waiting period shorter, the premiums would go up. If we made the benefit period shorter, the premiums would go down. If we made the waiting period longer, the premiums would go down, etc. Now, notice there's actually not an insignificant jump from payable to age 65 to age 67. That's why I actually like getting this policy to age 67 because the likelihood of you being disabled is the highest at these later years between age 65 to age 67. That's where you really want the coverage because that's when the likelihood of you being disabled is the highest. And then we go into the mode you can pay annually, monthly, quarterly, semi-annually. Here, I'm assuming you're paying annually. You do get a discount for doing that. This shows if you wanted to, you could change the premium by varying up the benefit period, the waiting period, etc. In my opinion, the most important thing is the benefit amount. All these other elements are important. I think a non-cancelable is really important because it protects your insurability. Own occupation is very important, maybe more important in some occupations than others. Residual is also very important. But if you're more budget conscious, you can see how you could potentially save some money here. Your current age is 40, your current annual income is $250,000. How much are we protecting? $6.75 million, dollars, and that does not include raises. This is a really important number. Think about the income you're going to earn from now until age 67 if you continue with the current income. Probably your income is going to go up over that time, but even assuming it doesn't, this is protecting $6.75 million dollars worth of income. Think about that. That's really important. This is why your ability to generate income is your most valuable asset, especially if you project that out over your entire working life. The potential cumulative benefit you could collect would be 3.7 million. If you throw in the catastrophic disability, it's 2.9 million. This could potentially be paid out in benefits if, God forbid, you are catastrophically disabled at a young age. And when it comes to insurance, we always want to protect against the most catastrophic event first, not the most likely event, but the event that, if it happened, would hurt you the most. And if it's very unlikely, that's good. That means it's going to be inexpensive. This is showing the breakdown between the monthly benefit amount and the catastrophic benefit amount. Because you being catastrophically disabled while working is unlikely, that extra 2.9 million of benefits is actually coming at a fairly low cost. All those benefits would be tax-free, not taxable. There's a few other things to point out here. I think rehabilitation benefits is important, that the insurance carrier tries to help you recover and get back to work sooner, which I think is what we all want. So they help you with that. And then, of course, there are claims specialists, but really you should be working through your agent. The agent should be taking point on all of this if it's a good agent. If you haven't spoken with your disability agent in a while, let me review your policy. Let's have a conversation. I see that a lot where someone has a disability policy, but it was sold to them years ago. They'd never reviewed it. They haven't spoken to that agent. They have no relationship with them. Come talk to us. We'll take a look at your policy. We'll let you know what you have. We'll help you best take advantage of whatever you have and at least understand it better.